It's true that mega cap has done very well, but if you look at a lot of other sectors, communications, industrials, financials, a lot of other sectors have done well, even materials of all things.
You know, what you're talking about is how Google, Alphabet performed afterwards. That's endemic of the market. That's why we're not seeing, we don't know what the substance of this trade agreement is with the EU, but if you'd gone
We don't know the substance, frankly, of many of the deals
of any of them, actually,
that have been announced. If anything, the most positive thing to come out of it is just taking that specific thing off the card.
Right, but my point is that if it had been 2-3 months ago, you would have seen the market have a much bigger move. So it's been endemic of the market. What's really the hallmark of this market is the pull through. So we pulled through on the earnings, and referencing your comments on the other mega cap performance. That's why I said earlier, unless you see something big one way or the other, the stocks aren't going to do much. So the market's just anticipated all this, which goes to your conversation about the valuation levels. You need a lot more really, really good, unexpected news to get the market.
Well, Canaccord today says that valuation is the stickiest wicket in their words. It is the biggest headwind in this market. It's not earnings. It's not anything else. It is valuation. The earnings yield on the S&P 500 of 4.15% remains marginally below the 10-year at 4.38. And we note that this condition of a negative equity risk premium has not occurred since 2001.
Scott, we should not be expecting multiple expansion, trading at 21 times calendar year 2026 estimates. What we should be looking for is those estimates to rise, which they have started to do. After going down all year, they are higher now than they were 3 months ago. Next year's earnings, $300 a share. That's the macro estimate, the aggregate estimate from FactSet. It was $298 just 3 months ago. And as the results keep coming in from the second quarter, I think we're going to see those full year estimates for next year creep up, where 21 is not the actual multiple that we're looking at.
I think you have to remember sentiment and positioning are in a much different place than they were 6 to 8 weeks ago, for sure. Sentiment is overtly bullish. Positioning is overtly bullish.
I don't know. Overtly is another questionable word. I mean, do you really feel that way? Tom Lee continues to come on the network and suggest this is still a hated V-shaped recovery. That institutional investors are not fully invested in the market.
I've been hearing that for
but it's factual
now.
It's factual that you still don't have full buy-in from institutional investors and hedge funds. You don't.
Hedge funds know, but hedge funds have missed everything. They're hedge funds because they're hedged, so they never. So rarely are they going to have exposure, net long exposure, 100% or 90%.
Sure, but I don't even know necessarily if long onlys have fully committed.
Long onlys aren't the asset allocators, so they've got to.
The point is that I would take issue with using the word overtly bullish. The feeling that I get, and the people that we talk to, is there's still a healthy dose of skepticism, not overt bullishness.
I don't know about that.
I think they're overtly whining. Okay, because they are participating, the market is going higher, and their deployment of their capital is what it should be along their guidelines.
I think I'm seeing a lot of reversal in that skepticism. I think I'm seeing a lot of speculation in places of the market that get me a little bit uncomfortable. And again, I want to emphasize this doesn't mean I'm bearish. Activity?
I mean, okay, let's go there. Let's talk about the speculative trade, because remember, Goldman had the note out the other day that we brought up to you. Quote, the recent rise in speculative trading activity signals near-term upside risk for the broad equity market. They also say that it increases the risk of an eventual downturn. We bring it up today again because, AppLovin reiterated outperform. The Ark Innovation Fund, ARKK, up 36% year to date. Weiss, I'm not sure that we've gotten your full view on this run that we've had in lower quality and highly speculative parts of the market, and whether that's something to be concerned about, because if that leg of this four-legged chair, not Jim's three-legged stool that he tried to introduce in the same part of the conversation last week, to which I repudiated that immediately. If that leg breaks, the chair becomes unstable.
Yeah. And that typically is a sign that the quality is maxed out in valuation. And then when the lower quality, we say junk, starts to rise, it's searching for performance because you've missed what's above. So it is a little bit troubling, but I also continue to believe that this is a market that just doesn't look at valuation as we used to collectively. You know, it's sort of like it's a side conversation. It's what strategists talk about because they've been involved in it for a long time. But it's really agnostic. It's momentum of fundamentals and momentum of price that drives the market.
Because you can't just make a blanket statement anymore, given the mega caps and the outsized weighting that they have and where their valuations are relative to the equal weight S&P 500. You can't make a blanket statement anymore and say the market's overvalued, because people will come right back at you and say, well, 6 stocks are maybe richly valued or more valued than all this 493 where they're still undervalued.
There is some, but I take a look, for example, what Caterpillar's done, and I own Caterpillar, and Caterpillar's done very well. I think Caterpillar's fairly valued. So sure, you're always going to find stocks, companies that you can buy that are a discount, but overall, you know, and I don't want to say they're that way for a reason. I don't believe in the efficient market theory that you have basically Vanguard and all the others. So there's always values, but when you take a look at where most of the capital goes, where the institutional portfolios go, I think you're pretty much fully valued.
Oppenheimer raises the year-end target on the S&P today to 7,100 from 5,950. Wow. So we blew past the 5,950. 7,100. Yeah. People would take that from here.
That's
right at 6,400.
That's a heck of a finish to the year. I believe to get there, you would have to have the broadening out. You mentioned the valuation on the S&P. The valuation on the equal-weighted S&P is somewhere around 18 times, which is far more reasonable than that. I also think.
Why do you need the broadening out to get there?
Because I just don't know if you're going to get a further multiple expansion from those 7 stocks.
Isn't that what this week is all about? That's in part what we're going to learn.
In the near term, yeah. I think in the near term it is. But again, I don't know if you're going to see today. And I looked last week. Again, it's my individual opinion. The price action in Alphabet, the earnings were phenomenal. The reaction to it, and there's a classic example, in my opinion, of a equity name. There was built-in skepticism. Myself and others had that skepticism. Jimmy, I know you took the other side of that. Congratulations, and you were rewarded for it. But I don't think you saw the type of price action that you should have been on the other side of that. And I think you could get very strong earnings this week. I think you could get further price appreciation, but I think you're going to run into the ceiling at a certain point. And I'm just urging cautiousness. Also understand, market structure has changed. 2025 is about momentum. You mentioned AppLovin. Okay, the ETF owns AppLovin from $76. I've never once come on this network and said, we own AppLovin for some fundamental reason. It's a $120 billion market cap. It's the largest company not in the S&P 500. And on the fundamental side, there are a lot of challenges in front of it. You have the Muddy Waters allegations. I'll let Muddy Waters and AppLovin's management deal with that. But I've never said it's been the fundamentals that's driving it forward. It's all about momentum.
So how do you deem it quality? Your ETF is about 2 things.
Completely.
Quality and momentum.
Absolutely, Scott. The momentum completely overwhelms the quality factor. So if you take a composite score on momentum and then you take the composite score on quality, it's almost as if the quality score would have to be so detrimental to weaken the strength of the momentum score. You take a company like AppLovin.
On the fundamentals of this company.
AppLovin or Palantir. No, I said I've never come on the air and said it is the fundamentals, the reason that we own this stock. I've never defended the fundamentals. I'm not questioning the fundamentals. I'm taking the fundamentals. I'm putting them over there for the analyst community to look at. I'm saying the reasoning behind us owning the stock has purely been momentum, and it has been a stock that has rewarded us in that regard because the momentum has been so strong, and it's indicative of the market.
But if you don't think that it meets the quality metric, then you've increased your own risk profile in this particular name, because momentum, as we know, can reverse it at any moment.
Absolutely it can, and there have been times that this stock actually has reversed its momentum. Remember, it was a $500+ stock in February, and I think post-earnings it fell from there. It's had a little bit of a bounce. We'll see as we move through the course of time and we measure the different time frames of momentum where the momentum score rests for this company. But I'm telling you that in the last 12 months, there is maybe Palantir. There's no other individual name we own that has a higher momentum score.
Okay.